G'day, and welcome back to another episode of the Bear of Bull Market Boulevard. Today is an extremely important edition. Today we're going to be talking about the superannuation industry in Australia. So let's get right into it. Today what we want to talk about is why do people put money into super and ultimately draw down a pension? So what we're going to be talking about first is the reason behind it, and most importantly, the tax incentives behind doing so. So in Australia, if you're an individual, and when I say individual, we're completely throwing out of the window just for the purpose of this video. We're not talking about family trusts, or we're not talking about companies. We're talking about mum, dad. We're talking about an individual who's just earning a wage, these sort of things. So an individual in Australia, as you can see on the right side of the screen, these are the tax rates for the 2024 financial year. Anything over $18,200, you're paying 19 cents to the dollar. Anything over 45,000, you are paying 32.5 cents to the dollar, and anything over 120,000, you are paying 37 cents to each dollar earned. And if you're one of the lucky people that earn over $180,000, from an unlucky sense, you are paying 45 cents to each dollar. So what does this mean? So as an individual, depending on how much you earn, you will be paying an XYZ amount of tax. So for the purpose of the remaining part of this video, we're going to assume you're on a income of, let's say, $100,000. So you'll be paying a small portion of 0% tax. So anything under 18,200, you won't pay any tax on. Anything up to 45,000, between 18,201 and 45,000, you are paying 19 cents. And anything between $45,000 and $100,000, you're paying 32.5 cents. So this will all make a lot more sense when we go on to the next slide. So when your funds or your money is within the superannuation structure, you only pay 15% on anything. So there's no 0 to 18,200. There's no $180,000 plus. You pay more tax. Everything is taxed at 15%. Now, small disclaimer here: there are CGT discounts applied. So if you do hold an asset for more than 12 months, the growth on that asset will have a CGT discount, and you'll only pay 10% on that. So for example, if you buy an asset for $100,000, goes up to $150,000 in value, and you sell it after 13 months, you won't pay 15%, you'll only pay 10% on the $50,000 capital gain there. Now, finally, pension. So when you move from individual to super and then finally to pension, putting these funds into your pension phase, anything that's earned within the pension phase, so that includes earnings and growth, they're taxed at 0%. Now, that's up to a certain limit. Of course, there are certain barriers, but we won't talk about that today. This is just talking about standard pension accounts below. We're just going to assume below $1 million at this stage. So finally, we see here 0% tax on pension. And this sort of answers the question, why do people want to put money into their superannuation, ultimately into their pension account? Well, as we've just discussed, the main reason behind that is purely because of the tax advantages. Simply put, superannuation and pension is just a tax structure. So same as your individual, and as I mentioned before, we're not going to talk about family trusts or companies in this instance, but super and pension are just tax structures. So the reason that people would want to move their money into super or pension pre-retirement, especially if they do have a significant amount of funds, is to avoid paying higher amounts of tax, because it doesn't matter what you earn in your individual name. If you're earning 10, 12, 15% on an investment, which is obviously ridiculously high, you will still pay tax on that. And if you're in a lower tax environment or zero tax environment, obviously there is a lot higher gain for you. So when can you access this money? Well, anything that's invested in your personal name, obviously you can access this at any point. With superannuation at this stage, the age is 60. And if you are permanently retired from the workforce, you can put your money from superannuation into the pension phase at 60 as well. However, if you are still working at 60 up until age 65, you will still be taxed at the superannuation rate of 15%, which is called a transition to retirement. So if you ever hear the word transition to retirement, it is not a tax-free rate. You'll still be taxed at 15%. The next slide, again, saying why do people move money from individual to super to pension? We're going to go on to the next slide, which is more important. The primary reason to conclude this video is when your funds are in pension and you are drawing a pension. So hypothetically, you've got $1 million in your pension account and you are drawing $100,000 a year. When you draw down those funds, there are the funds will be accumulated from distributions, dividends, these sort of things, or whatever cash you hold within your pension account. Any of these earnings have no tax payable at all. However, if you hold this in your individual name, of course, there will be tax payable. So if you had $100,000 worth of distributions, dividends, these sort of things, there will be a certain tax applied to it based on the individual rate. And if it was within superannuation, if you had $100,000 of earnings, just hypothetically, you would be taxed at 15%. So it is in everyone's best interest to put as much as they can into the pension phase when they are over the age of 60 and retired. Or already have money in the pension phase at this stage, so they can draw down their retirement income tax-free. I hope this video explained in very, as fast as possible, to be honest, but it was just an introductory video to explain the different tax rates for individual superannuation and pension. If you have any questions at all, leave them in the comments, or anything else, just do let me know. But otherwise, thank you very much for watching as always, and have a wonderful day. Thank you.